Rama, good to be here. Thanks for having me.
Yeah, thank you very much. A little bit about Brett. Brett Swart is considered one of the most well-rounded capital gains tax deferral experts and informative speakers in the US. He is the founder of Capital Gain Tax Solutions, is an exclusive deferred sales trust trustee, host of the Capital Gain Tax Solutions podcast, and an EXP commercial multifamily broker in Sacramento, California. So with that, Brett, you want to add anything to your background?
No, that's good, Rama. Thank you so much for sharing. I'm also a father and a dad, and I'm a dad and a husband, and I've got my wife and I have 5 kids. I also split some time out in St. Augustine, Florida, as well.
Okay, got it. So what is your life motto, Brett, before jumping into other stuff?
Yeah, my life motto. I would say my favorite leadership quote or theme that I strive to live by would be to learn to work harder on yourself than you do on your job. If you work hard on your job, you'll make a living. If you work harder on yourself, you'll make a fortune. And that has to do with working on your faith, your fitness, your finances, your personal development, your leadership. Things that are going to really increase your character and leave a lasting legacy beyond just wealth. Really be able to pass down something to your family and your community by using the gifts you've been given to be a blessing and help to others.
Got it. Very powerful. Thank you. So let's jump into our main concept for today's podcast episode. So capital gains tax solutions. So why is very important? How it is different from 1031 or any others? Stuff.
Yeah, so the Deferred Sales Trust is very different than anything else because it gives you really 3 things. And I call this the art and science of the DST. It gives you flexibility, it gives you freedom, and it gives you purpose. Everyone we work with at Capital Gains Tax Solutions, our focus is to unlock a transformational capital gains tax and a wealth plan using the DST. And the DST is not to be confused with the Delaware Statutory Trust. It's actually known as a Deferred Sales Trust. And it's different than things like a 1031 exchange because A, it works for all asset types of any kind. It works for crypto, businesses, all real estate, investment or primary home, whereas a traditional 1031 only works for investment real estate. 2, it gives you flexibility of timing, being able to dollar cost average into multiple different asset types, stocks, bonds, mutual funds, lending, or back into real estate. And then also 3, it gives you the ability to be passive or active. You can be an active entrepreneur with the capital, or you can be passive and just be retired, or you can do a mixture of both. It's actually a great way to diversify your time, your energy, your wealth, and also to be able to be entrepreneur or active. So those are or passive. Those are some of the main things that differentiate the Deferred Sales Trust.
Got it. So based on your experience, which asset class mostly benefiting using capital gains tax solutions?
Anyone who has a sales price of an asset that's more than $1 million and at least $1 million gain. In other words, the gain has to be big enough in order to offset the tax paying. Paying by way of tax is somewhere between 25 and 50% of your gain, depending on what state you're in, and depending if the asset has depreciation. And so anyone who's looking for a way to build their wealth in a tax-deferred manner, also someone might have estate tax challenges and are looking to eliminate that 40% death tax. So those would be the main people that we would want to work with to help them invest and help them to make good decisions with their wealth.
So got it. Thank you. So is the rules are same across all the states, or did you see any difference?
So the Deferred Sales Trust works in all 50 states. So no matter what you're selling or where you're selling, it works for it. It's a federal tax law known as IRC 453, which is known as an installment sale, is the one foundational part of the tax structure that we use, and it's coupled with the business trust. So when those 2 things are combined, it's known as a Deferred Sales Trust. And we just need to make sure we follow the parameters and the procedures of setting up everything prior to. But the simple answer is it's just an installment sale. It's known as the seller carryback. And as a seller, you can carry paper for a buyer and defer tax on what you haven't received. Same thing here. We can do it with a trust, and we can delay the tax on what we haven't received yet.
How long we can delay the tax?
The way we structure our deals, they can go on for typically 10 years, and every 10 years you renew for 10 years, and then you can pass it to your kids and they can continue to do the same thing. So I guess one answer would be for as long as you would like or your family would like to do so. but in 10-year increments. Think of these promissory notes with interest-only payments, with the balloon payment coming due in 10 years. And then at the end of the 10 years, you can renew it for 10 years. Or you can just take it all and pay your tax. You can also do 5-year notes or 3-year notes. It just kind of depends on how long you're wanting to delay the tax.
Got it. So what is the standard time frame? So based on your experience, 10 years is
The standard is 10 years. Yeah, most people want 10 years, and they're typically structured at 6 to 8% is the interest rate on the promissory note. And then at the end of they're taking somewhere between 3 and 4% interest payments starting in about year 2. They can also start it right away, and they just kind of live off the interest, and they keep that principal intact. And at the end of the 10 years, they can renew and just continue to live off the interest, pay tax on the ordinary income that they receive on that, but they keep that principal intact. But it really is up to each individual taxpayer.
Got it. So what are some best practices around this topic?
I think the best practices are just making sure you're clarifying and envisioning what you want your wealth plan to be. And that's not just your financial plan, that's also your time and your energy and your wealth as your entire who you are, right? The wealth of your family and the relationships, the wealth of your time and your energy, the wealth, of course, with your finances, and having tax flow and cash flow kind of meet together to make sure that it's serving you for what you're trying to achieve. So the more you have a clear vision on that, the clearer you know where to go. Now, once you kind of know where you want to go, now the question is, what strategy or strategies? Sometimes we're using a partial 1031 exchange and a partial deferred sales trust, or a partial Delaware statutory trust and a partial deferred sales trust are going to help you to get to where you want to go, which often means you need to do the next stage, which is build. So you need to build a team to help you build the strategy or strategies to help you execute what you had on your original vision. And the last part of it is just the freedom aspect. So what it actually unlocks when you can connect those two, and you have a team in place, you have the strategies in place, you have a clear vision for where you want to go, then it unlocks the freedom for a lot of our clients, like who are selling primary homes, commercial real estate, who are selling businesses, cryptocurrency, and they want something other than something that's going to lock them into strict timeframes like a 1031 exchange. So those are some of the best practices to use for the deferred sales trust.
Got it. Thank you. So what are some risks if you're not implemented properly?
Yeah, the number one risk if you don't implement it properly is that it doesn't even work. In other words, you take what's called constructive receipt because it wasn't properly structured within the purchase and sale agreement, wasn't properly structured in the APA agreement. You took the capital in a way that triggers the tax, so you're not even eligible to use it. That's number one. I think number two would be you don't have a clear plan and experience with the investments that you're putting the money in, because investments all have risk. So just because it's in a trust doesn't mean it protects the investments. We still have to put it into something to make money. So you also want to have a good know, like, and trust factor with the investments you're putting the money into. When you combine those two things, it can go pretty smoothly if you have a team that sets it up properly and the right amount of time and the right order. You delay the tax because you take a promissory note, you become the lender, and then you have a team to help you execute the investments. Which, by the way, you can also execute the investments with the trust, which is really cool. You don't have to be tied to just being passive. You can be active, which is honestly my favorite part about the deferred sales trust.
Got it. Yeah, thank you. Those are very, very important points. So how does the DSC save a failed 1031?
How does it differ from a 1031?
Yeah, how exactly it save a failed 1031? Yeah.
Yeah, so the main thing would be, remember, a deferred sales trust is not a 1031 exchange, meaning we have none of the requirements as it pertains to timing. That's probably the number one difference to focus on. You're able to sell, defer tax, but not have to put it into like-kind investment property in a short period of time. And this unlocks the freedom for you to invest at optimal timing. And I'll give you a story for this. In Sacramento, we had a potential client who we wanted to sell, help him sell, but he had the 1031 exchange as the barrier because he didn't want to overpay for a property. This is in 2006. He ended up not selling, losing all of his wealth, all 50 million of multifamily properties. And we came to find out that the deferred sales trust in about 2009 that could have saved him, be able to sell, pay off all of his debt, defer the tax, but instead he loses it all. He ends up losing his house and losing his marriage and going bankrupt. It was a whole disaster. So I would say the major thing is optimal timing. Number two, the major thing would be a new depreciation schedule. So in a 1031 exchange, your depreciation schedule travels to the next property. That's not good. You want to increase your depreciation schedule or have a higher one to offset your cash flow. We call this tax flow. For every dollar of cash flow, you want a dollar of depreciation ideally to wash away in that given year. But if your old 1031 travels and you have a low depreciation schedule and still a high cash flow, guess what? You're having to pay tax on all of this. So with the deferred sales trust, if you bought that same property using the DST through a joint venture partnership, the way we structure it, you're able to get a new depreciation schedule, which you get the majority of. So that's a powerful way to build wealth. The next one would be just diversification, the ability to diversify away from an asset type that's highly appreciated, like a California multifamily property, like a tech company, like cryptocurrency. When a year ago, when most people should have sold all of it out. So that is the best thing to be able to diversify. The last one has to do with the ability to move out capital outside your taxable estate. And this is really powerful because if you're ultra high net worth, 40% death tax is subject to people who own more than 24 million of wealth inside of their taxable estate, or 12 million if they're single. So that's set to cut in half in 2025. And so the goal is to get the wealth out. The challenge is most people have to give it all the way to charity, have to try to gift it away, which is going to be a slow process, and/or they have to buy a bunch of life insurance to offset it. And so we eliminate all of that hassle, and you can sell your asset and then one day move all of your equity outside your taxable estate, eliminating that 40% death tax. So those are just a few of the reasons why you would use the deferred sales trust versus the 1031 exchange.
Got it. So at what stage we need to engage DST, expert?
What's the timing for it?
Yeah.
Yeah. So what's the timing to engage in using the deferred sales trust? I would say earlier the better. The neat part of the way we work is we work on a no cost, no obligation basis. For any reason you want to use the trust, your deal doesn't close, you don't owe us anything. However, it's very crucial that we set up the trust prior to the escrow having all the contingencies removed, the buyer removing all contingencies in escrow. If they remove them all, then it creates a situation where it could be constructive receipt. So we need to have the trust or some language inside of there that you're doing this planning prior to all of that happening. And if you do that, we can set everything up in time. That's number one. Number two could be if you're in a 1031 exchange, we're setting this up with a qualified intermediary that will work with you to have this as a backup plan. Not every qualified intermediary wants you to know about this. And so we work with, if you work with us, we work with our number one strategic alliance for 1031 exchanges and a deferred sales trust. And they'll give you both options alongside of us to make sure that everything is lined up properly. So, and in that scenario, we can save a failed 1031, basically our failing 1031 on day 45 or day 180. And so just connect with us, capitalgainstaxsolution.com. We can walk you through all that.
Got it. So what is the process, overall process, at high level?
Like how does it work? Yeah, the process is A, set up a trust. B, assign your interest or ownership to the trust prior to the close of escrow. And then C, have a third-party buyer all ready to go to close escrow. And D, I guess, receive a promissory note at close of escrow. E would be the funds are invested into something that you approve, that you have 24/7 access to view online, or into investment real estate properties, passive or active, or other business ventures. And so that's the general process, is finding a buyer, you being the seller, the trust comes in right in between the sale at close of escrow. And it's basically two sales, you selling it to the trust selling it to the ultimate buyer, trust receiving the capital, you receiving a promissory note, the ultimate buyer taking title to the property and they're out, or the asset, and you're left with a promissory note with the trust owing you the money. And that's how this whole thing works.
Thank you. That clearly explains how exactly it works. Thank you. And how to grow like any CRE syndication business using deferred sales trust?
Yes, the number one way to, I think, grow your commercial real estate syndication business is to be able to unlock capital from sources that otherwise didn't know how to get to you without paying a bunch of tax. In fact, the American Bankers Association and a number of other studies show about $32 trillion is going to pass from the baby boomers to the millennials in the next 20 years. And this is known as the largest wealth transfer in the history of the planet. Now, every single day, 10,000 baby boomers are turning 65 in the US alone. There's 77 million in the US alone. So you look at this massive amount of wealth that's going to transfer. And a lot of this wealth is tied to high-end primary homes, businesses, and commercial real estate. So those assets are illiquid that people want to retire from and want to downsize, want to move. They feel real estate rich and cash flow poor, a lot of them, and they want to sell, defer the tax, and then they can go back into syndications with you, part of the funds, which is an amazing way to unlock capital versus trying to convince someone to sell a $5 million house they're going to pay $2 million of tax on, and then to show up with you with a couple million. Why not help them defer the capital gains tax, and I already have a couple more million to invest the next day. And that's the beauty of the deferred sales trust. Is going to give you the pre-tax ability to invest rather than post-tax.
Got it. Got it. Thank you. So how to build a tax deferred wealth plan?
So how to build a deferred sales trust plan kind of goes back to a little bit of what I said before, but the key is envisioning where you want to go, and also clarifying where you're at right now. I mean, we talk with sellers every single day that they're tired of the toilets, trash, liability, termites, tenants, all of the challenges that go along with owning investment real estate or even businesses. But also we ask them to clarify, where do they want to be with their time, their energy, their wealth, their next entrepreneurial freedom, or their retirement. And once you have a clear vision of where you're at and where you want to be, guess what? You can take the next step, which is what plan and what team's going to help you to get there. And that becomes the plan of the wealth plan with the financial advisors we work with. We work with your CPA, work with me as the trustee. We interview commercial real estate companies and different investment opportunities. And essentially, we start to build this wealth plan with this tax flow plan using the DST. And the last part would be just how do you pass it to your kids or the next generation? Well, we do that through a living trust typically. And so all of that together creates the deferred sales trust plan.
Got it. Thank you. So would you share any case studies from best case scenario point of view and also challenging case scenario point of view?
I'm not sure I answered the question. Are you saying what's the best case scenario versus worst case scenario?
Yeah. So would you share based on your experience, share me in one best case example.
Oh, okay. Yeah, I'll give you the Monday morning quarterback. So it was a deal, 2000, mid 2000s, a gentleman sold a $20 million asset in Minnesota. He's used to doing 1031 exchanges, and he sold at the peak. And he said, I think something's happening. I think 2008, something's going to happen. And so instead of overpaying in the 1031, he used the deferred sales trust and he parked it into conservative stocks, bonds, and mutual funds that were hedged and protected, weren't subject to the big crash of 08, and basically kind of just broke even for a couple of years. And 5 years later, the bank calls him and says, hey, that property you sold to that buyer a few years ago? He says, yeah. He goes, well, we just foreclosed on it. We're curious. Do you want to buy it back from us? He goes, well, maybe. What's the price? And they say 60 cents on the dollar. In other words, 40% less than what he had sold it for. So he used the money in the trust to buy back, to buy back that property at 60 cents on the dollar. Right, which is incredible. All tax deferred, by the way, not paying a single dollar in tax yet. And that is the power of the deferred sales trust. Sell high, buy low. So the best case scenario is, you sell crypto at 68,000 a coin, and you buy back at 15,000 a coin with the trust, all tax deferred. You also, sell real estate high and buy low. You also, finally be able to spend time and energy with your family, right? I had a client who sold a high-end primary home in Palo Alto, and he got closer to family in Nevada, and he was able to pay off all of his debt. His kids were out of the big house, and now he's free to travel and have more cash flow and just have more freedom. So those are the best case scenarios. I think the worst case scenarios would be investments don't go the way you want them to go, or you sell out of real estate and you put maybe too much into the stock market and you're not too comfortable with the stock market, or stock market goes down. In other words, you sold something high and you went into something low. And when you went in low, those things went lower. So there's, nothing's ever guaranteed for some investments, but I think where people get a little bit, can get a little bit worst case scenarios if they're in something they made a lot of wealth in one thing and they're in another thing, and that other thing's not going as well as they thought it would be, and they're not as comfortable with that. It's kind of like a fish out of water. You made it in real estate and now you're in the stock market, or vice versa. And that sometimes it's hard to break those ways of building wealth. And so that would be not a great situation if that happens.
Got it. Thank you. So how this current higher interest rates or inflation impact on, DST?
I think it creates opportunity for people to finally pause. And what I mean by that is to get money on the sidelines during a higher interest rate that we're seeing, and not have to overpay in that 1031 where you're selling high and buying higher. Not only buying, or maybe you're buying a little bit lower, or even maybe about even. But if interest rates have gone up drastically, then your borrowing cost is eating up a lot of your cash flow. So it finally gives people an opportunity to actually look at this even closer. I mean, we're closing deals about every single week, and just keep closing across the country. But a lot of people, especially in the 1031 exchange real estate world, which is what I grew up in and I love, they're actually looking at this and going, wow, I really need to look at it, because otherwise I'm putting myself in a really compromised position. If my cap rates are about the same, but my interest rates are much higher. In other words, it's a negative arbitrage. So this higher rate interest environment is hurting. Number two is it's likely to increase taxes. As inflation goes up, taxes typically go up. Okay. And when that happens, guess what? You're in trouble too. We're all in trouble, right? The government has a spending problem, which means we have a tax problem. So it becomes even more valuable if I can defer more capital gains tax. I think they're talking about federal going from 20 to 26 or 28 next year. And then you add like state of California, 13.3 if you're in California, and Obamacare at 3.8%. I mean, it's huge, 37, 40 or more percent. So that is some of the challenges there. Hold on a second, sorry. All right, sorry about that. That was kids had a little argument there. Everything is okay.
So how do you see like DST, next 2 to 3 years or next 2 to 5 years?
I think it's our vision is to make it a household name. I think it's going to become more and more of a household name, and there's going to be more people who are going to think outside the box into something that's newer to them. Although it's been around for 27 years, thousands of closes, billions of assets have sold, over 20 no change IRS audits. Yet there's still people every single day. They are skeptical, they're cautious, but it's batting 1,000. It's perfect. It's never lost, not one time legally. Investments are investments, but you can always diversify. That's what we love about the Deferred Sales Trust. So I think it's just going to become more popular, and I think it's going to serve clients at a high level, and it's going to give them the freedoms they really want.
Awesome. And let's shift towards personal side. So any personal habits that are helping you to be successful?
Yeah, I would say, faith, family, fitness, finances, personal development, leadership. And that has, those are things I try to practice every week or sometimes every day, ways to be building and investing into those things, such as working out every single day, just about drinking a lot of water for my health, getting good sleep, time in prayer and meditation. I try to do it every single day, time with family, time increasing and learning from leaders, growing my leadership through podcasts, through conferences, through books, reading a lot. All of those things helped me to grow as a leader. And if the leader gets better, everything gets better.
Awesome. So share me any one personal learning or any one decision that you took that impacted your life positively.
I would say just being willing to persevere through a challenging time of the 2008 crisis, when a lot of people got out of the commercial real estate brokerage arena. I persevered through it. I kept pushing through to learn more, to grow more. That's actually how I learned about the Deferred Sales Trust, and my career is now here. But that took me, working side hustles at a place called Cheesecake Factory, nights and weekends. And then by day, making cold calls and helping clients and banks and negotiate with banks and go through challenges with the 2008, multifamily Sacramento people, having challenges with rents and paying on time to the bank. So all of that, just persevering through a time that was tough to be in the business, to learn and grow a lot.
Awesome. So any book that impacted your life?
Yeah, so the Bible's impacted my life a lot. I mean, that's my number one book. That's the number one. Business book, I would say, everyone says Rich Dad Poor Dad. That's been a big one. I would say one recently is called "But Never Split the Difference" with Chris Voss, and it's negotiation. It's also communication, human communication. So those are some of the main ones I really enjoy right now.
Awesome. And how can listeners can connect with you, Brett?
They can go to capitalgainstaxsolutions.com. They can also look for the new book that's coming out soon. It's actually called Building a Capital Gains Tax Exit Plan. It's on Amazon here in the next 20 days or so. But go to capitalgainstaxsolutions.com, download our other free ebook as well. You can subscribe to the YouTube channel, Capital Gains Tax Solutions.
Awesome. And thank you very much, Brett.